Michael, yes. In fact, I heard your comments about 20% years, and I think that's spot on. That the question we have to ask in 2023 is, what is the probability the market has an above-average year? Number one, I think it has a lot to do with credit markets, which, as you know, spreads have been stabilizing and rallying. A year after high yield has a negative year, which is this year, the average gain's 22%. I think volatility, which was really elevated this year, historically drops more than 20% in a year where it's averaged over 25, and typically the market gains are over 20%. And for those who think the Fed's going to crush the market, one thing to keep in mind is that historically from peak to max drawdown, when the Fed starts a hike cycle and then pauses, the average drawdown is 18%, peak to pause. And then, when the market finally bottoms, we've already fallen 20%. So we've already discounted a Fed tightening cycle. And that's where I think inflation becomes the big pivot because, for the last 3 months, inflation's annualized around 2.5%. I think that the February FOMC is really the time where the Fed could true up, and actually it looks like we're in a dovish trajectory, and I think that would be a huge catalyst for markets.
When you say that inflation has annualized, in the last few months near the target, I guess you're talking about core PCE, I assume, on that metric?
Yeah, you can correct core. You can do core CPI or core PCE. Both have annualized at roughly 2.5%.
Yeah, gotcha. And I guess the question then is, does that just leave us open to be concerned about what the economy actually is able to offer? The lagged effect of the tightening, all the leading indicators of inflation, of recession that seem to be taking shape.
That's definitely the battle that's shaping up, because on the one hand, people who pick stocks focus on the earnings decline. But as you know, when we look at, and I used to be a stock analyst, if 2023 is a year where earnings are declining, but they rebound in 2024, well, one, markets begin to look through that. And in fact, on average, stocks bottom 12 months before earnings estimates bottom. So one of the things we have to wonder is this an extended earnings contraction that isn't already discounted by a 20% decline?
It's an interesting stat, and it's certainly key as we talk about an earnings recession looking at fourth quarter and going into 2023. I think you've got 7 of the S&P sectors expected to see earnings contract in Q4. That's according to Refinitiv. Where would you be putting money to work right now, Tom, given the fact that this is uncertain and given the fact that you personally, last I checked, I think have a street high in terms of where the S&P ends next year?
Yeah, I think it's. I think that the least controversial view to make is that cyclicals could begin to work because, as you know, we've already had a pretty big decline in PMIs, and that would be industrials. I think that's going to be a more consensus view. I think one of the less, and I think energy still works. That's been our favorite sector since 2020, but I think one of the groups that could surprise us is technology. And I know investors have just taken a beating this year on tech. But there's really 2 reasons. Number one, tech is going to benefit from things that potentially happen near a bottom, like the dollar weakening, the Fed pausing and rates falling. That's just simply, has to do with valuation. But more importantly, as we think about the structural problem of labor shortage, which is going to continue, the historical solution has always been for companies to increase their investment in industrial and technology spend to create productivity. So tech actually might have a tailwind because of a weaker dollar and the sort of upside as companies begin to try to invest their way out of wage inflation.
Tom, what do you see as the single biggest risk to your thesis next year?
Well, I think the risk remains that the Fed has to stay tighter. And therefore, it actually doesn't lead to a soft landing, it leads to an outright recession and maybe even a financial crisis. So I think the thing that remains the biggest risk is if wages actually accelerate. That wage growth, even looking at the sticky Atlanta Fed wage tracker, that's beginning to plateau. Even 3-month annualized is lower than it was 6 months ago. So if that begins to accelerate, then it means the Fed has a lot more wood to chop, and that raises the risk.
Yeah, clearly that is the higher for longer and tighter than we're hoping for, the market's hoping for scenario. Tom, good to talk to you. Thanks very much. Happy New Year.
Yeah, Happy New Year.